Hedge funds are investment funds geared towards high net worth individuals, institutions, foundations, and pension plans. They can be very risky and charge high fees, but they have the potential to deliver outsized returns. Hello, dear viewers. In today's video, we're talking about hedge funds, a limited partnership of private investors whose money is managed by professional fund managers who use a wide range of strategies, including leveraging or trading of non-traditional assets to earn above-average investment returns. Hedge fund investment is often considered a risky alternative investment choice and usually requires a high minimum investment or net worth, often targeting wealthy clients. Before we get into more details about it, as always, we have a bonus fact for you towards the end of the video, so stay tuned. Number 1. Understanding hedge funds. The term hedge fund defines this investment instrument as the manager of the fund often creating a hedged bet by investing a portion of assets in the opposite direction of the fund's focus to offset any losses in its core holdings. A hedge fund that focuses on a cyclical sector such as travel may invest a portion of its assets in a non-cyclical sector such as energy, aiming to use the returns of the non-cyclical stocks to offset any losses in cyclical stocks. Hedge funds use riskier strategies, leverage assets, and invest in derivatives such as options and futures. The appeal of many hedge funds lies in the reputation of their managers in the closed world of hedge fund investing. An investor in a hedge fund is commonly regarded as an accredited investor, which requires a minimum level of income or assets. Typical investors include institutional investors such as pension funds, insurance companies, and wealthy individuals. Investments in hedge funds are considered illiquid as they often require investors to keep their money in the fund for at least 1 year, a time known as the lockup period. Withdrawals may also only happen at certain intervals such as quarterly or biannually. Number 2. Types of hedge funds. Hedge funds target select investments and pools of securities primed for gains. Global macro hedge funds are actively managed funds that attempt to profit from broad market swings caused by political or economic events. An equity hedge fund may be global or specific to one country, investing in lucrative stocks while hedging against downturns in equity markets by shorting overvalued stocks or stock indices. A relative value hedge fund seeks to exploit temporary differences in the prices of related securities, taking advantage of price or spread inefficiencies. An activist hedge fund aims to invest in businesses and take actions that boost the stock price, which may include demands that companies cut costs, restructure assets, or change the board of directors. Number 3. Hedge fund strategies. Hedge fund strategies cover a broad range of risk tolerance and investment philosophies using a large selection of investments, including debt and equity securities, commodities, currencies, derivatives, and real estate. Common hedge fund strategies are classified according to the investment style of the fund's manager and include equity, fixed income, and event-driven goals. A long or short hedge fund strategy is an extension of pairs trading, in which investors go long and short on two competing companies in the same industry based on their relative valuations. A fixed income hedge fund strategy gives investors solid returns with minimal monthly volatility and aims for capital preservation, taking both long and short positions in fixed income securities. An event-driven hedge fund strategy takes advantage of temporary stock mispricing spawned by corporate events like restructurings, mergers and acquisitions, bankruptcy, or takeovers. Number 4. How hedge funds make money. Australian investor Alfred Winslow Jones is credited with launching the first hedge fund in 1949 through his company A.W. Jones & Co. Raising $100,000, he designed a fund that aimed to minimize the risk in long-term stock investing by short selling, now referred to as the long or short equities model. In 1952, Jones converted his fund to a limited partnership, added a 20% incentive fee as compensation for the managing partner, and became the first money manager to combine short selling, the use of leverage, and a compensation system based on performance. Today, hedge funds employ a standard 2 and 20 fee system, a 2% management fee, and a 20% performance fee. The management fee is based on the net asset value of each investor's shares, so an investment of $1 million garners a $20,000 management fee that year to cover the operations of the hedge and compensate the fund manager. The performance fee is commonly 20% of profits. If an investment of $1 million increases to $1.2 million in 1 year, $40,000 is the fee owed to the fund. Number 5. What to consider before investing. As investors research to identify hedge funds that meet their investment goals, they often consider the fund or firm's size, the track record and longevity of the fund, the minimum investment required to participate, and the redemption terms of the fund. According to the SEC, investors should also do the following when deciding to invest in a hedge fund. Read the hedge fund's documents and agreements, which contain information about investing in the fund, the strategies of the fund, the location of the fund, and the risks anticipated by the investment. Understand the level of risk involved in the fund's investment strategies and that they equate with personal investing goals, time horizons, and risk tolerance. Determine if the fund is using leverage or speculative investment techniques, which will typically invest both the investor's capital and the borrowed money to make investments. Evaluate potential conflicts of interest disclosed by hedge fund managers and research the background and reputation of the hedge fund managers. Understand how a fund's assets are valued as hedge funds may invest in highly illiquid securities, and valuations of fund assets will affect the fees that the manager charges. Understand how a fund's performance is determined and whether it reflects cash or assets received by the fund as opposed to the manager's estimate of the change in the value. Understand any limitations to time restrictions imposed to redeem shares. Number 6. Hedge funds compared to other investments. Hedge funds, mutual funds, and exchange-traded funds, or ETFs, all are pools of money contributed by many investors that aim to earn a profit for themselves and their clients. Hedge funds are actively managed by professional managers who buy and sell certain investments with the stated aim of exceeding the returns of the markets or some sector or index of the markets. Hedge funds aim for the greatest possible returns and take the greatest risks while trying to achieve them. They are more loosely regulated than competing products, with the flexibility to invest in options and derivatives and esoteric investments that mutual funds cannot. Thank you for waiting patiently. It's now time for the promised bonus fact. As of 2022, the most notable hedge fund include Elliott Management Corporation with a 55-year-long history and over $50 billion in assets under management, or AUM. Its core holdings are in the energy sector. What are your views on investing in hedge funds? Comment down below and let us know what you think. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time.